Emerging market assets remain under severe pressure today as Turkey's currency crisis continued to stoke concerns of emerging market spillover effects. The lira slide has continued despite efforts by Turkish authorities to provide instruments to try and keep the currency afloat. Things got really dire for the country when President Donald Trump tweeted his administration's policy decision on Friday to whack double the latest import tariffs on steel and aluminium, which saw a more intense sell-off on the lira. As a consequence, other emerging market currencies like the rand got hard hit, the local currency hitting 15.47 against the US dollar in the early hours of this morning. Well, to talk Turkey, currencies and ramifications, I'm joined on the line by Jameel Ahmad. He's from FXTM. Thanks very much, Jameel. It's always a pleasure to have you on the show. It's been a crazy time on the currencies front, so explain the mechanics. Why does Donald Trump's tweet to lob a massive tax on Turkish goods now result in a massive sell-off of the Turkish lira?
Thank you very much for having me. It's always a pleasure for FXTM to contribute. To be honest with you, this tweet from President Trump was just one of the many reasons why we see a crisis in the Turkish lira. Over the past fortnight or so, political tensions between the United States and Turkey have increased. However, there are a number of different reasons why the currency was suffering even beforehand, including concerns that the previous market weakness in Turkey, specifically the lira, would weigh on the economy when it comes to the current account deficit, when it comes to paying back dollar or euro denominated debts, when it comes to increased price pressures and inflation, which leads us to our biggest worry, which was actually central bank independence, because President Erdogan has been very outspoken over not liking higher interest rates in the past. And because the Central Bank of Turkey recently left interest rates on hold and they did not raise interest rates despite inflation reaching extremely high levels of somewhere around 15%, if I remember rightly, that this is one of the main reasons why the Turkish lira has actually sold off and why it's hurt other emerging markets and taken them with it.
So when the lira is sold off for its own idiosyncratic reasons that you've outlined very nicely, why do other so-called emerging markets also come under siege, with the rand falling close on 9% this morning alone, when Turkey's problems should not necessarily be our problems?
It's a very good question. Typically speaking, the Turkish market is an emerging market, including the economy, and it's an indicator of investor appetite towards risk. Because there's such high market uncertainty over the current Turkish lira crisis, it's impacted global markets actually. But when it comes to risk appetite, it means less attraction towards risk. Emerging markets are classified as riskier assets, which has hurt the emerging market stocks and the emerging market currencies as a whole. So the South African rand was actually was the worst to take a hit after the Turkish lira. But we're seeing some punishment in Latin American FX as we speak, with the Brazilian real, Mexican peso and the Argentine peso. But the global markets, so the major stock markets in the world this morning, also swept lower. So it's quite a global effect, but just emerging markets always take the hit from market uncertainty.
Given the knee-jerk reaction to emerging markets as a collective, will investors now step back and re-look at the individual fundamentals of the markets they've sold off in one foul swoop?
Good question. That's a very good question. Look, emerging markets have been oversold and do look like they were heavily oversold on this news, because there's nothing actually of an indicator of fundamental shift in these economies. However, there's so much uncertainty in the markets, it's quite likely possible that the Turkish lira will continue to sell off, which means more woes for the Turkish market. The Turkish currency might even weaken even further than what is a 70 to 80% weakness this year, which is very, very material. So there's a possibility this could weigh on the Turkish market, weigh on the emerging markets, and our currencies such as the South African rand could still have some more pain in them, despite what happened this morning. But the good news is, after the South African rand weakening somewhere around 10%, I think it was on market open, that the currency is now only lower by about 2%. So it has shown some resilience, it has bounced back, but there obviously was quite a scare in the early hours of this morning.
Yeah. So it's not only emerging markets that got hit, but the euro also got hit. Given that region being in close proximity to Turkey, what sort of exposure does the eurozone have to Turkish assets?
Absolutely. So there's two different factors at play here. One, Turkish banks and Turkish companies have debt that's either denominated in dollar or it's denominated in euro. It's estimated around 50% of Turkish debt is denominated in one of these two currencies, euro approximately 20%. So there's big concerns that because the Turkish lira has weakened so much against the dollar and the euro, pretty much everything else, that Turkish companies or borrowers might not be able to reach their debt obligations. On the other side, European banks are seen as also being exposed to any shocks from Turkey, which is why the euro also suffered early today. It hit its lowest level since approximately last July. So we're seeing quite a global impact from Turkey, and there's a real reminder to investors how interconnected our global economy and our world markets are in the current day and age.
So, Jameel, you're fairly familiar with Turkey. I mean, with the currency having fallen over 40% against the US dollar this year alone, what sort of impact have you seen on the ground for ordinary folk?
Well, the last time I was in Turkey was actually at the beginning of this year, where the currency crisis was nowhere near the levels as it is today. Typically, the good news for Turkey is that it relies on exports and it relies on tourism. There is no better time to go to Turkey than at present. And if you're there today or over the past couple of days, you've just seen like a 20 or 30% discount on your visit. The bad news comes with if you have debt in Turkey, which is going to be denominated now in higher currency. And also that inflation is about to get out of control in Turkey. It's already at 15%, and I have no idea what's going to happen to inflation with the most recent weakness, which is really dramatic and astonishing. And the central bank, the independence is a big concern for global investors. We don't know how much more this could get worse for Turkey, which means it could impact other markets and take it with it.
To stem the bleed of the Turkish lira, ultimately, does Mr. Erdogan have to now go cap in hand to the IMF? Is it that bad, especially given that a lot of their debt is denominated in foreign currency?
It's a difficult one, actually. Is it now at the level that they need to go to the IMF? I'm unsure, because this is 2 days of very severe weakness. If this continues to the levels of what Argentina have seen earlier this year, then possibly. But there's only one thing that investors want to really be buying the lira and to be more settled regarding Turkey, and that's higher interest rates. This is also the most problematic risk, because President Erdogan is obviously against higher interest rates. So it depends how much longer this fiasco prolongs for, to be honest, will determine what happens next.
Absolutely. And then coming back to the South African rand, which is of key interest to us who use it. Of course, it's still way above the $14 mark against the US dollar. What do our fundamentals look like? If things improve and the risk aversion sort of subsides, do you see us going back below 14, or is this sort of a sustainable level now?
Well, the South African rand, let me check. It's around 14.30, 14.40 as we talk. Look, the South African rand moving back above 14 against the dollar was a psychological level that the rand could weaken further than what it is at present. However, if we move back below 14 against the dollar, this will be a sign that the most recent moves in the South African rand were really overdone and they were an exaggeration. The problem is, as we were talking about currency weakness, the rand has weakened a lot due to a very volatile external environment that does not seem to be going away. South Africa is about to see its own increased inflationary pressures, cost of living, and so on. So what does the central bank do about this? Lower rates is needed to increase the economic momentum. Lower rates could encourage borrowing and encourage consumption. However, if inflationary pressures continue to increase in South Africa, there's now a case to raise interest rates. So it'll be interesting to monitor how the SARB, the South African Reserve Bank, react to these external risks.
Unfortunately for us, the Reserve Bank has made it pretty clear that if they do move interest rates, it's going to be up. But thanks very much for your time, as always, Jameel. That was Jameel Ahmad. He's from FXTM.